Good morning, good afternoon, good night, good evening, depending on the time that you're watching this video. Welcome to another video by me, Estanguna. Welcome to Finance by S. If you're seeing me for the first time, my name is Estanguna and I teach on investing, I teach on finance, I teach on taxes as well, and anything money. Basically, welcome to Finance by S. Guys, thank you so much. Let me take this time to appreciate you for all the support that you've been giving me so far. Thank you so much. And in today's video, I'll be giving a breakdown of the different investments depending on now the point that you are in life. And I will be comparing money market funds to treasury bills and treasury bonds and also SACCOs. So these are different investment vehicles or different investment vehicles that, depending on where you are in life and your objective, you could easily go for one and not the other. So I want to give that clarity that when you're in this situation, this is the one you actually need to go for, so that it aids you in your daily decision making and eases your life, basically. So without further ado, let's get into the video. So I will start with money market funds, then treasury bills, bonds, and SACCOs in that order. And I will, so let me stop the explaining and just start. So for money market funds, these are good for saving and for liquidity. So this one will come through for you if you have an amount that you just don't want to be lying in your bank account. If you're saving up for something to get, maybe make a big purchase or maybe make a big investment, a money market fund, it's almost like a money market fund is where you start, because it will give you that interest and it will also give you that liquidity. If I want my money, I withdraw and I get my money, the same day, or within a maximum of 3 days, I have my money. Yet it's been accumulating interest. So that's how a money market fund will come through for you. A treasury bill will come through for you if you have money that you can lock up somewhere for 3 months, 6 months, or 1 year. If you're willing to lock up your money for more than 3 months, then a treasury bill will do for you, because the interest rates right now they're giving. The interest rates right now are 16% and above. So it's a good return for sacrificing your money for 3 months. So if you have a good amount of money that you can put away for 3 months, it can stay there, then a treasury bill would be highly, highly, highly recommendable. A treasury bond, it's the same, but now you have to lock up your money there for 2 years going up, 1 year and above. 10 years, all the way to 30 years, a treasury bond will do justice to your money. Then a SACCO comes in if you're looking to get a loan and you want to take advantage of a more affordable interest rate on your loan. So that's when you go for the different, vehicles. So the second way I want to compare this for vehicles is in terms of the risk involved. And for a money market fund, this is a low risk investment. It's minimal. Your capital is preserved at the end of the day. For treasury bills, these are actually, I remember when we were in school, we used to call them the risk-free rate, meaning there's no risk at all. But in reality now, there's no investment which is risk-free. Because like the likes of Ghana, there are countries that have actually defaulted on their domestic debt, but the risk is very minimal, very, very minimal. That also applies for treasury bonds, whereby you'll get your capital at the maturity of your bond, and you'll also get your 6 months, coupon, your interest rate after every 6 months, and it is almost guaranteed. For SACCOs, the risk is also minimal. However, for SACCOs now, there's that risk of capital erosion. In that, especially when now it comes to liquidation, you have to find you as the member, you have to find someone to buy, a willing buyer of your shares. So, and this one, it's in a normal market. So you could find someone who's willing to buy, but at a lower price. So you find that you're losing some of your capital, and that's the risk in SACCOs. The third way I'll compare is now in terms of the amount you need to invest. For money market funds, you can start with money market fund is always the beginning point. You can start with 100 shillings. You can contribute any day, any time. It's favorable for both an employee, someone in business, self-employed, because you can contribute anytime and you'll be getting interest, on your contributions. However, what I usually say is that make sure it makes economic sense, because you can't be contributing you can't like be injecting money into your money market fund every other time, and the interest that you're getting, it's a low risk investment. As I have said, so low risk, relatively lower return, lower return. So when you make those transactions as frequent, you find that the transaction cost is higher than the interest that you're getting. So it's always favorable if you have the discipline to accumulate your money for 1 month, for 2 months, and then make one big transaction. That will always work for you. Also, in terms of withdrawing, for most money market funds, the ones that I have interacted with, the first withdrawal in a month is free. Other withdrawals in the same month, you'll be charged some transaction fees. So you can make one withdrawal a month. So for what was I saying in terms of capital? So capital money market funds as low as 100, as low as 2,500, you have your investment account. For treasury bill, the lowest capital you need is 100,000. But here's the thing: treasury bills and also bonds, that are sold at a discount. To mean, if I'm making an investment of 100,000, what I will actually transfer to CBK is 100,000 minus the interest rate, so that when it matures, I get my 100,000. So in reality, you will need about 93 at this particular time. You will need about 94,000 there in order to be able to get your 100,000 when it matures. For treasury bonds, the minimum investment is 50,000. Also works the same. They are sold at a discount, so you might need about 40 something thousand there. For circles, it depends on the circle that you're going for, but with a minimum of, for the ones that I have interacted with a minimum of 3,000, you're good to go, because I have seen that you have to have something to go into your shares, something to go into your savings, and something to go into your current account, like that works almost like a bank account. So with a minimum of 3,000, you're good to go with the circle. The other thing I'd like to clarify, however, now for circles, you'll be having to make the monthly contributions, which are mandatory. For money market funds, no one will tell you about that. For T-bills and treasury bonds, once you make the initial, that's it. So the other key point to compare is now the return that you expect from the different investments. For money market funds right now, because they go hand in hand with the T-bills, a good one will give you 15 to 18 or 14 to 18. For T-bills, it's 15 to 17, 16 thereabout. For treasury bonds, it's 16 all the way to 18.2%. That's a very good rate. For circles, it's just like, it's like a company. Now it depends on how they're doing, how it's performing. But I've seen 15 to 20% for the dividends, because a circle will pay you in two ways, or will earn you passive income in two ways. There's the dividends on the shares and the interest on the savings. So dividends 15 to 20, for interest 11 to 15% on your savings. Yes, so those are the different ways you could compare these different investments and make a decision. But ideally, it always depends on the objective that you want to achieve. If you want something that you can easily get your money within a month, money market fund is the one. If you want to get a loan at a better rate in future, then a circle is the one that I would recommend. If you want a good rate and you can lock up your money for more than 3 months, then go for a treasury bill. But you're looking to have the same capital to invest somewhere after a year, a treasury bill would grow your money perfectly. If you want to now, invest in long term, something to be giving you passive income after every 6 months, treasury bonds, and you can always layer your treasury bonds to be getting monthly income. Thank you so much for watching. I hope you have learned. I hope you've also enjoyed the video. I also enjoyed researching on it. If you have any question, any comment, as always, put it down in the comment section. Thank you so much for watching. Take a moment to subscribe, please, if you haven't. And thanks so much for all your support. We'll see you in the next video. Bye.